Hi, welcome to another episode of Talking Tax with Alex. This is a court case analysis episode, so we're going to go back to looking at a court case that came out in tax court and analyzing the situation and the facts and the rulings of that court case. So this will be a little bit more technical and focused. On this video's agenda, I'm just going to do a quick introduction on why I chose this case. We'll review the facts, see what happened and what was being litigated. And then we're going to discuss the issues. So something we're doing a little different this time is we'll save the analysis for the ruling and my closing thoughts on the entire court case for a second part video. So a quick introduction. Why did I choose this court case and what's this court case about? Well, this is a court case involving charitable contributions of vehicles. So charitable contributions in the tax world are strictly regulated, and it's a little bit, I guess you don't usually know what you don't know until you need to know. It's kind of funny to say it that way, but most of the time people are not giving to charity every year, or maybe they are, but they're giving different types of property. If you're lucky enough to be giving to charity every year, you might be giving cash. There's different types of property. There's a whole body of law that governs what you do and need to do and what you can't do and all of this stuff for charitable contributions. So I figured it'd be an interesting topic and an interesting court case to dive into it and use this specific example for what happens when you donate a vehicle. So this court case is actually, it went through regular tax court and then it was appealed. So this court case actually went through two layers of tax court. So that makes the ruling stronger. And I'm not going to say which way it went because that's going to be for next episode. But this court case is different than any other ones we've done so far because it's gone through the tax court twice. And it's been looked at by two different judges. So what are the facts? This tax court case was for the 2009 and 2010 tax years. So the original tax returns by the taxpayers, they filed a standard deduction, or on the tax return they claimed a standard deduction, and these tax years were assessed tax deficiencies of $93,000 and $19,000. The reason why claiming the standard deduction is important here, and it's an important fact, is because if you claim the standard deduction, that means you did not claim a charitable deduction, because charitable deduction goes on your itemized deduction tax return. So itemized deductions, very common ones are property taxes. If you own a home, it's going to be your property taxes, the interest you pay on your mortgage, and charitable contributions. Like those are the three big ones that you usually see on a itemized deduction. If you don't have a home, but you give a lot of money to charity or something, you might have an itemized deduction. But if you're if you're like me and you rent and you have a W-2 and I don't donate a whole lot to charity, so I claim the standard deduction, which I think the majority of Americans do. Interesting fact in this case, though, is taxpayer filed an amended return, not 6 years later, but 5 years later in 2016, April 14th, 2016, which is probably I don't know if it's quite outside the statute of limitations, but anyhow, it's really, really long after the originally filed return. And on this amended return was the first claim of a charitable deduction, which is very interesting. So the originally filed return, he got assessed some tax, and then he filed an amended return and said, oh, I have the charitable deduction. By the way, I donated 50% interest of a 40-year-old aircraft. So the vehicle in this court case is an aircraft. It's not, a car or something that or maybe even a boat. It's an aircraft. So the issue, or one of the issues, is that the claimed value of the donation was $338,000, but taxpayer purchased, it was his 50% interest in 2007 for $21,000. So just a quick math moment here. Something that I thought was interesting is you take the deficiency of $93,000 plus $19,000 and you divide it by, I'm just assuming his tax rate is the 37% tax rate, which is the highest tax bracket, just guessing here. But if we do it that way, then you can kind of see the claimed charitable deduction is a $338,000, which would effectively be just a little over what his deficiencies were, because you take your deduction and you have to multiply it by the tax rate. So my math moment here, I just did the reverse of that to see how much the deficiencies are worth as a deduction, or how much deduction he needed to cover these deficiencies. So he would need $302,000 of deduction, and he filed an amended return after he got assessed, his deficiencies, saying, "Oh, I have a deduction of $338,000. I'm covered." And interesting to note, and very important in this court case, are the quality of documentations. So there was missing 1098Cs. 1098Cs for donated vehicles, or transfer vehicles, excuse me. There's incomplete Form 8283. We'll go into what that is later. And there was just an overall missing information, there was just overall missing information. So that's the facts of the case. So the issues in this court case really revolved around what are the charitable contribution substantiation requirements. So very plainly put, gifts greater than $250 require a contemporaneous written acknowledgement. So this is a defined term in the tax code, and so I put an acronym here, CWA, but it's a defined term. That's why it's all capitalized. So CWA needs to be received within 30 days of the donation. There are 6 statutory requirements. So those 6 are: you need to have the name and the taxpayer identification number of the donor, the vehicle identification number or something similar, a certification of intended use or material improvement of the property and the intended duration of such use. So like, what are you going to do with the property? A certification that the vehicle would not be transferred in exchange for money, property, or services before completion or such use or improvement, whether the donee, the charity, provided any goods or services in exchange for the vehicle, and a description and a good faith estimate of the value of goods and services. So when you donate a vehicle, you're also required to have contemporaneous written acknowledgement of all of those 6 things listed in the code. Qualified vehicles also require a 1098C from the charity, so the charity needs to provide documentation, 1098, that they received such a vehicle. So 1098s and other like tax documents, maybe you heard of a 1099. These are documents that are written by an organization that are provided to everybody, and the IRS included. So it's like copies go to the IRS, goes to you, and the entity or whoever keeps a copy for themselves. So this is record keeping. And then gifts over $5,000 require qualified appraisals. So the issues in this court case were also about the quality of documentation provided. So contemporaneous written acknowledgement provided was actually initially provided on the amended tax return filed in 2016, so not on the originally filed tax return. Most of it was dated December 30th, 2010, but the courts were kind of the way it was written. It didn't really think that they thought it was true. It was very legally written that it was purported to be in 2010, but it kind of sounded like they thought it was backdated, which maybe it was, maybe it wasn't, but that's kind of how the court was writing it. The documentation provided was addressed to the other 50% owner of the aircraft. So remember, in the facts here, it was only a 50% ownership in the aircraft, and so the taxpayer basically said, "Oh, here's my documentation," and they used the other 50% owner's documentation. So all of the headers and everything was addressed to that person, not to them. The documentation provided was missing taxpayer social security number and identification. The 8283, Form 8283, was signed in 2016 and missing taxpayers' social security numbers. So again, this is a Form 8283 is your charitable contribution form for non-cash gifts, which has all the other additional requirements, such as if you need to have an appraisal, if you're donating a vehicle, it puts the description of the property, the value of the property, the date contributed, etc., etc. So this form is basically a supplementation. If you did not donate cash, you need to file this form so that you can list out and describe what you donated. There was no Form 1098-C from the charity, so there's no documentation and no receipt of the charity actually, or there's no proof that the charity actually received such a donation. So that, you know, that was missing documentation. And the substantially complied doctrine that the taxpayer argued for is actually only applicable to regulatory requirements, not statutory requirements. I know that technically, I'm not going to get into the technicalities of it, but basically statutory requirements are like what's written in the tax code. So when we look over at the 6 statutory requirements of what's in section 170F for charitable contributions, you know, I read off 6 things that you just have to have. Name and taxpayer identification number, right? Vehicle identification number. Like, these are really basic things. Regulatory requirements are, they get a little bit more involved, and there might be, you know, additional things that get confusing on subjects that are new or evolving or something like that. So there's a little bit of leeway in that regard, but not here. And that's it for part 1. Just my closing thoughts are, in part 2, we'll spend more time analyzing the court ruling, and we'll do a court ruling analysis. My closing thought here right now is just charitable contributions are strictly regulated. So if you're not working with your tax advisor, you don't have a tax advisor, maybe hire one in a year that you are doing a large charitable contribution. That's not cash. Cash is easy. You can prove cash. Anything that's not cash, you know, I recommend you consult your tax advisor. So that's it for part 1. If you like this content, please like the video, subscribe to my channel, and comment me or email me your thoughts. Thank you. Bye.